Hello, and welcome to the next in our video series on IFRS Hot Topics. I'm Sandra Thompson. I lead our global IFRS team for financial instruments. I'm here today with Mark Randall, a very familiar face. Welcome back, Mark, who also works on financial instruments in the UK. We're going to talk today about that very hot topic of IBOR reform. So what are we talking about with IBOR reform? Well, that's the process that's going on in pretty much all parts of the world to replace benchmark interest rates. So things like sterling LIBOR, US dollar LIBOR, Euribor and other similar benchmark rates around the world. That is coming up pretty fast now. We've talked before about how that's coming up about 2021, 2022, so not far off, and it has some important accounting implications. One thing to note is that the reforms aren't happening in one big bang, and they're not happening at the same time, both in different countries, but also even within a country. And in many cases, we expect that derivatives that reference things like LIBOR will move to a new reference rate before the non-derivatives, things like debt instruments. And that's important when we talk about some of the accounting implications in a minute. Okay, so that's just refreshed you on what IBOR reform is. Mark, do you want to bring us up to speed with what the IASB's been doing?
Sure, Sandra. So the IASB has a project that's got two phases looking at IBOR reform and the potential accounting impacts. Phase 1 is looking at what it terms as pre-replacement issues, so accounting issues that could arise before contracts are actually changed for these reforms. And then Phase 2, in due course, will look at accounting consequences and impacts as and when contracts are actually changed. And I guess the most important thing to be aware of is last week, the IASB published the actual amendments to IAS 39, IFRS 9 and IFRS 7, looking at Phase 1. In terms of what it covers at a high level, it's all focused on hedge accounting, which, given its kind of forward-looking nature, is the aspect of accounting you'd expect to potentially be impacted first of all. And a real objective is that uncertainty due to LIBOR reform really shouldn't cause hedge relationships to be terminated. However, having said that, whilst the reliefs are very helpful in many ways, and we're going to explain those, ineffectiveness from hedges is still going to need to be reported through the income statement. So it's not a complete pass to not to do anything as a result of this. In terms of unpacking what those changes are, there's broadly 6 different areas. So Sandra, do you want to kick off and talk us through the first couple?
Thank you, Mark. So the first one I'm going to talk about is a highly probable assessment. And this is for hedges of forecast transactions. In order to get hedge accounting, a forecast transaction needs to be highly probable. Let's take the example of a company that's hedging a forecast issuance of LIBOR-linked debt. It asserts that's highly probable, starts doing cash flow hedge accounting. And then sometime later, because of these reforms, it might say, I'm not sure it's going to be LIBOR-linked after all. My expectation now is that maybe it will be SONIA debt, not LIBOR debt. Does that mean that the highly probable test is failed, so therefore you have to stop hedge accounting? Well, what the reliefs do is to say no, you basically assume that the hedge benchmark rate hasn't changed. So if in doing your highly probable test on day one you said it was LIBOR, you can carry on assuming it's LIBOR. Very important relief. The second one is a bit similar. It's to do with recycling the cash flow hedge reserve. So let's assume an entity actually has issued LIBOR-linked debt. So it's doing its cash flow hedge accounting, putting amounts in the cash flow hedge reserve. Generally, you'd recycle those to the income statement over time, over the life of the debt. However, if at any point you expect the hedge cash flows won't happen, then you have to recycle immediately. Now, if your hedge cash flows are LIBOR cash flows, there might come a point at which you say, well, actually, I don't expect it to carry on being LIBOR for the full life of the debt. They're going to switch to SONIA. And the question is, do you have to recycle your cash flow hedge reserve immediately? And similarly, the reliefs say no, you can assume that the hedge benchmark rate remains unchanged. So if it was LIBOR before, you assume it stays on as LIBOR, and therefore you carry on recycling over time. Very valuable relief. So that's the first couple. Mark, do you want to take us through the next couple?
Sure, Sandra. So the next one is around prospective effective assessment. So that's either the need to have an economic relationship under IFRS 9 or under IAS 39 to expect the hedge to be highly effective in the future. And again, clearly uncertainty arising around IBOR reform could put that assessment under stress. So for that reason, what the relief allows you to do is make those assessments based solely on what the contracts say today, so you effectively can shield yourself from that risk that one or both of those contracts might be amended, and indeed even if both might be amended in the future, that they might get changed at different times. So again, with the objective of allowing the hedge relationship to continue through the period of uncertainty. And then the next relief, which actually is associated with that, is around the retrospective test requirement in IAS 39, where the hedge needs to fall between the 80 to 125% boundaries. In response to feedback from comments on the initial proposals, what the IASB is, they've given relief around that, so that not only do you get the relief on the prospective, you don't find yourself potentially quite quickly failing later due to the retrospective assessment. And quite fundamentally, what the relief allows you to do is disregard that failure on the retrospective assessment, but continue the hedge so long as all the other hedge accounting criteria are still met, and in particular that the prospective effectiveness assessment is still being met. So really what that does is put really quite a strong onus and priority on making sure that prospective assessment is robust, because effectively the whole hedge is pretty much going to be dependent upon that.
Yeah, and I guess the other important point there is you still have to measure all the ineffectiveness. So if your hedge is, say, 75% effective, you still get 25% ineffectiveness coming through the income statement. So,
exactly, there's no hiding place.
So Father Christmas has his limits, I think.
Indeed.
Okay, I'm going to move on to the next one, which is about risk components. We now need to move on and think about a fair value hedge. So say a hedge of fixed rate debt, where the hedges of changes in fair value attributable to movements in, say, LIBOR. Now, in order for that to qualify for hedge accounting, LIBOR needs to be separately identifiable and reliably measurable. Again, that would be fine today, but as the reforms get closer, it may be that the market benchmark moves from being predominantly LIBOR to, say, being predominantly SONIA. And in that context, you might question whether LIBOR still is separately identifiable. What the reliefs do is to say you only need to do that separately identifiable test at initial designation of the hedge when you first do hedge accounting. You don't have to come back and keep doing it on an ongoing basis. So if the market does switch, you haven't got this, oh, I'm caught by that market switch. There is no exemption from the reliably measurable, and that's because, as we said a number of times, you have to measure all the ineffectiveness. So if your risk component is not reliably measurable, you can't do that, and at that point you would have to stop hedge accounting. Mark, finally, disclosures.
Indeed, disclosures never escape when there's some changes. They always come with disclosure requirements attached. So there's really three key areas to disclosures. The first is quantitative disclosures around the nominal amounts of the hedges that are impacted by the relief, really to enable users to gauge, is this pervasive and actually being relied upon for almost all the hedges or only a subset. There's also a requirement to disclose any significant judgments or assumptions that needed to be made in applying the reliefs. And then thirdly, there's some qualitative disclosures that need to be given. Firstly, explaining broadly what the impact of IBOR transition is likely to be on the entity, and then also setting out what's the transition plan that the entity has got to manage through all the various changes that are coming through with it. And I think what I would observe is that even if an entity isn't taking advantage of these reliefs, those disclosures, I'm sure over time, will become increasingly a focus from the market and from investors to get reassurance that the company understands what the impacts might be and is managing them well.
Okay, so finally, I hope we've illustrated there are some very practical, important reliefs given by this amendment. So the obvious question is, well, when can companies do them? I should say the reliefs are mandatory, not optional, and they are required from the 1st of January 2020. However, you can early adopt, and given they are reliefs, we actually expect a number of companies will want to early adopt. That will be subject to endorsement. In Europe, there's a fast-track endorsement period that's been kicked off, aimed to enable adoption for 2019 year ends. So in summary, the aim of the reliefs is to enable hedge accounting to continue during the period of uncertainty. They're not a complete free gift. You do still have to, in particular, measure and capture all the ineffectiveness, and you still need to apply a prospective test. But they will be very useful. We do expect many companies to want to early adopt them. And as Mark said, there's a very important point around disclosure. Increasingly, the market is looking for entities to tell them about what they're doing in response to these reforms, and if you like, to spot the laggards and the companies that are not on top of the reforms and how they're managing the process. I hope you've enjoyed listening. We'll come back in due course and give you an update on phase 2, but thanks for listening. Bye-bye.